we think about this as a value-focused investment grade mandate. And by value, we're trying to maximize the yield for default probability that we're taking on with each of the investments in the portfolio. We think about three key aspects to the fund. So one, we adjust our credit exposure opportunistically. So we might not have a full allocation to credit, depending on the potential for macroeconomic weakness. We have a countercyclical approach to duration and credit exposure. So taking on more of each when we're getting adequately compensated for those things and less when we're not. And that's based on the level of the term premium and what credit spreads are doing. And then third, we're able to hold up to 25% in non-investment grade securities. And we do that by either holding Pender Corporate Bond Fund units, or in situations where we have high conviction and we think that the investment might outperform the corporate bond fund as a whole, then we would drop an individual investment into the fund. So we found that some investors have been looking for a fixed income solution that's somewhat less credit exposed. And given the shorter duration bias and an outsized allocation to high grade credit, the Pender Bond Universe Fund was designed with exactly that in mind, following an investment strategy that's similar to that which we employ in the corporate bond fund. It's produced returns over the longer term. And so in this fund, we use that same process, but with less credit exposure. In addition to that, the individual non-investment grade lines that we hold in the portfolio where we have high conviction, those have been a key driver of returns in the fund since inception. So we think about ourselves as business analysts first. A key question that we're always asking is, what is the value of the business? And does it cover the debt to the level of the capital structure that we're invested in? And then in addition to that, in a situation where we think credit fundamentals are improving, that's often something that leads to credit rating upgrades. That comes with some spread tightening often, and that's something that we're looking to achieve with the investments that we make in the fund. So the majority of the fund is in liquid, high-grade credit. And so that provides ballast and also liquidity to the fund. We don't reach for yield in terms of extending duration, so that moderates volatility to some degree. And we're looking for areas of the market that are relatively undervalued and that would benefit from a rotation out of the more expensive areas of the market and into these areas.